What's up, YouTube? This is Casey, and thank you guys so much for tuning back to the channel. So today I want to go over with you all the top 7 things that I have learned throughout my many years in day trading that is going to make you guys a profitable day trader. If you want to learn to day trade, if you want to skip over the many years of losing that I had to go through, if you want to go over the what ifs, and you just basically want to listen to this video in its entirety, these are the top 7 strategies, if you will, that I have learned throughout my many years of day trading, and I'm going to be sharing those with you guys today. Listening to this video in its entirety is going to be a very important thing. If you guys don't already know, day trading is a very serious thing because it involves a lot of money, it involves a lot of emotions, it involves a lot of patience, and it's very easy to lose money. There's a statistic that shows that at least 95 to 98% of people who attempt day trading fail. So literally out of 100 people who watch this video, 98 of you will fail. Just think about that percentage. And so these 7 steps are the things that I have learned that is going to try to help as many of you guys as possible succeed at day trading, irrespective of your account size. So I want to go ahead and give these to you. Hopefully you find these very valuable. Hopefully you listen to them and you try to implement them. And of course, if you guys have any questions, please make sure that you comment below. I'll be more than happy to answer those. So without further ado, let's hop into this. The number one thing that I think people need to truly understand about day trading is you have to control your emotions. Now, that's a very general statement, but I want to break down the categories of what I mean by controlling your emotions and why that's so important. So day trading is about 80% emotional because you're putting money on the line and you're trying to make money, and you're trying to make money in a matter of minutes or seconds or hours. And you know that there's a possibility that you could lose money. And many times when you hit a trade, when you hit the trade button, you'll immediately be upside down on the trade. And then there's that emotional aspect with seeing yourself in the negative, or you're up on the green and you're not quite sure where to enter or where to exit. Emotionals. Yeah, trading is a very emotional thing. And if you're not able to actually control yourself with your emotions, you're going to very likely lose money. So what are some of the things you can do to control your emotions? Well, the number one thing that I recommend people do is do not trade with money that you need. So if you ask my opinion, again, this is my channel, so I'm just kind of giving it to you guys, laying it out for you. I'm not sugarcoating this. Day trading is a rich man's game, meaning, think about what day trading is, right? You're taking money and you're putting it into the stock market that is 70% controlled by large, wealthy institutional traders and investors who have hundreds of millions of dollars, and you're trying to beat them at their game, right? Think about that for a second. You're trying to take money from the markets and you're trying to do it with very limited knowledge or information. You have technical indicators, you have whatever's in the news, but you're basically trying to do it with very limited information. You're trying to beat the house at their game. And so in order to do that, you really have to have a clear understanding of your emotions, why you have entered a trade, what your exit and what your entry strategies are, and that's basically it. So in order to do that, you don't trade with money that you need, because if you do, it's just going to totally make your trading decision making 100 times worse. Which takes me to my next point. You can't trade with less than $25,000. So it used to be that the government and the SEC allowed you to day trade for less than $25,000. You could do 2, 3, 4, 5,000. But what they found was that people who couldn't really afford to day trade were day trading in the hopes of making a lot of money in a short-term basis, and people were wiping out their savings, $3,000, $4,000, $5,000, $10,000. Just not knowing what they're doing, not having the cash reserves to even lose the money. And so now it is a law, it is mandatory that you have $25,000. If you do not, what will happen is you will be allowed to make a day trade. You will actually be allowed to make up to 3 day trades in a 5 business day period. But anything beyond that, you will not be allowed to make. If you attempt to make an additional day trade within a 5 business day period, your account will get frozen. Sometimes you'll get a warning first and then they'll freeze it, but eventually they'll just stop letting you trade. So you can't trade for less than $25,000. I personally think that you need about $30,000 to $35,000, $40,000. And the reason I say that is because I've yet to meet anyone who was able to actually go into the stock market and just flat out start making money day trading day one. It's just very rare that happens. But again, just want to kind of overall reiterate, emotions is very, very important with day trading. Which takes me to my second thing, position sizing. So when I was younger, and I'm younger, I mean about 10 years, 10 years ago, I'm in my 30s now. When I was younger, I just wanted to YOLO. I love the idea of just day trading and then just putting $10,000 in a stock and hoping that it went up 10% the next day, or 20% in a week, or 30%. And many times that does and can happen, particularly when you're trading with some of the smaller or mid-cap stocks. But position sizing is so important, and I say that because it's all about long-term and it's all about mathematics. So when you make a trade, all right, if you make, let's say your first trade, you lose 50% on your first trade. Well, it's not like it's not as though if you do your second trade and you get 50% that you're back to where you started. No, you're back at 75%. You're still 25% down. So if you start off with $25,000, you lose 50% of that, you now have $12,500. Well, now if you make 50% back of that $12,500, that doesn't equal $25,000. So position sizing is very, very important, and it's because it allows you to continue to stay in the game, right? Every time you put an order on, you don't know if that order is going to immediately go against you. You don't know if you're going to get faked out. You're not exactly sure, but you know that you want to be able to cut your losses quickly, and you want to be able to let your winners run, and you can't do that if you're YOLOing, because it's just a matter of time before you blow your account out. Now, even if you put $20,000 and say, I don't know, let's just say Check. I'm just picking on those guys right now because I think they're filing for bankruptcy shortly. But Chesapeake Energy, let's just say you put $25,000 in Chesapeake, and the moment that you buy it, the stock craps out 20%, right? So now you're down $5,000 in your account, and now you have to try to make that money back, and it's just very, very not likely that it's going to happen. You want to be able to cut your losses fast, and you want to be able to make your winners run, and you can't do that if you're not properly position sizing. So my recommendation is that you use about 10%. Some people would say 2 to 5%. I'll say up to 10% of your maximum account on a particular trade. So if you have $25,000, conservatively, you should be day trading with $2,500. That allows you to make sure that you are actually making smart, consistent trades, that you're actually making profitable trades, and that you're understanding and learning the game, and you're understanding the strategy. You want to make sure that you're able to stay in the game and that you're not getting kicked out by making a couple of bad trades, because by then your learning stops and you got to come with more money, right? So position sizing is super important. I didn't know this in the beginning. I lost about $15,000 trying to YOLO. That's even when I did research on stocks, and it just isn't a very smart thing to do. So I cannot stress to you guys enough how important it is that when you are day trading, do not YOLO. Make sure that you're making trades that are conservative to your total account size. The third thing is keep it simple. You have all of these gurus and these people selling you these help books and selling you all these packages. I don't say you guys any of that stuff. I just don't believe in it. Right? I think that anything that you want to learn is on the internet, or it can be put in a condensed educational video such as this that can save you guys a lot of time and a lot of money for free. And of course, all I ask for in return is a subscribe and a like and a comment, right? So, a lot of time goes into these videos, and I just want to make sure I save you guys a lot of headaches. And so, hopefully a like and a subscribe will show that appreciation. So, third thing, keep it simple. One of the things that I learned in the later years in the game, is not using a lot of indicators. So I've studied a lot of day trading books. I followed a lot of the penny stock traders, such as the Timothy Sykes back in the day, and a few other ones. And there was a lot of stochastics indicators and moving average converging divergent indicators, and just a bunch of the RSI indicators, and there's the Bollinger Bands, and there's the Fibonacci retracements, and all of these different indicators that can the money flow indicator. And if you have too many indicators on a stock chart, you can get really confused, because even a lot of them sometimes can contradict each other. And then it really makes the decision-making process and making a trade that much harder. I have found Now, when it comes to day trading, it should be very simple. And the only things that you really need from a day trading perspective is a simple moving average, an understanding of support and resistance, and an RSI. That's what I use. So I'm going to say that again. Simple moving averages, such as like a 9-day moving average, a 20-day moving average, a 50-day moving average, a 100-day moving average, and a 200-day moving average. Those are the ones that I use. There's 5. I use the RSI. RSI just basically means oversold or overbought, right? It's a relative strength indicator. And then I use, of course, the volume. But and of course, so that's those. I was going to say, in addition to the moving averages, I do also look at support and resistance levels. That's very important because you need to understand the ranges the stocks will go up and down on a day trading model, right? Throughout the day, stocks will test a certain high and a certain low, certain high and a certain low. But overall, that's what you need, right? You need to be able to understand your support and resistance. You need your moving averages. You need an RSI, and obviously, and of course, volume indicator as well. That's pretty much it. All right, keep it simple. You don't need a lot of indicators. It's complicated. And actually, that helps me transition to my 4th point, which is the support and resistance levels. The support, and if you guys don't take anything else out of this video, and I hope you take it all out, because every single one is just as important as the other in terms of the 7 steps. But I cannot iterate to you how important the 4th step is, the support and resistance. If you don't learn anything else, if you know nothing about anything else in the history of day trading or stocks, understand support and resistance. This is whether you are day trading, swing trading, whether you're scalping, whether you're YOLOing, whether you are investing. Support and resistance levels are everything when it comes to putting money in the stock market. Now, they are not a definitive. It doesn't mean that they will not break support or that they will not break resistance. But there are general areas to where stocks like to bounce, even if it's just temporarily, which is all you care about as a day trader. One of the reasons that support and resistance are also very, very important is because a lot of the times you will be right in the direction of the stock, but not in the very moment. And so if you are purchasing off of resistance levels, it's going to almost immediately bounce down off of that. And so if you're going long, you're going to more than likely lose money, right? So when you are buying and selling stocks, always make sure that you're buying off of support and not resistance. Very important. I can't tell you guys how much money that I've lost over the many years trying to buy breakouts. So you'll have a lot of gurus that'll tell you, buy high and sell higher. They should just put a gun to your head because they're stealing your money. You do not buy high and buy higher. That is not how you make money. You buy low and sell higher. I don't know any professional day traders, any swing traders, or even any investors who buy high and sell higher. Now, I know people who buy when stocks are starting to cup, meaning when the stocks have been oversold and they're starting to kind of turn around. And that's a great buying strategy when it comes to a day trade, or swing trade, or investing. Stocks that are kind of oversold and they're starting to show some life and some bounce. But as far as buying a stock that's overbought and it's really, really high, whether it's on the day, whether it's on the weekly, whether it's on any other time frame, it's just not a very smart thing to do unless you think that there's a lot more upside. Understand that with day trading, it's all about risk reward. So if a stock is oversold, it's a good time to buy. If it's overbought, it's a good time to sell. Just remember those 2 things. 5th thing, very, very important. Personal opinion, stay the hell away from penny stocks. Now, there's different definitions for penny stocks, but when I say the word penny stock, I'm actually referring to any stock that is under $1 billion market cap, $1 billion with a B. Now, the traditional sense of penny stocks mean literally a stock that's worth, below $1, 90 cents, 80 cents, 75 cents. I say stay away from anything that is so volatile that you can make 30% or lose 30% in a day. That goes back to the YOLOing. One of the reasons that penny stocks are so dangerous and so volatile, and again, I've lost so much money in that, is because penny stocks are highly manipulated to what we call pump and dumps. And a pump and dump strategy is when you will have, it's a little bit, it was very successful back in the day. It's still successful in today's terms, but it's a little bit more subtle. But the overall idea of it is that you will have a company or an individual that will release a bunch of news flyers or articles or rumors that this particular stock is going to go up because of clinical trials or because of this or that. And so they will buy in a lot of stock, of a particular ticker symbol, and then they'll release all these news articles and all of these rumors, and then people like you who like penny stocks will go in, you'll put your money into it. Oh man, I'm going to double my money at $2,000 in a day, and then it'll maybe go to $3,000. Oh my God, I'm going to triple it, and then the next day you're down and you've lost everything. It's a very, very dangerous game. It's literally, in my opinion, it's gambling. It is not something that a day trader is going to do, at least not a successful one. Not only that, but if you are a day trader and if you're classified as one based on having the $25,000, you're not going to be messing with penny stocks. Day traders are not looking to get rich overnight. They're looking to make income, and in that making income, they can make thousands of dollars or tens of thousands of dollars a month. And you're not going to do that penny stocking. I don't know anyone who's ever made a lot of money penny stocking. It just doesn't work. It can't support significant position sizes. The liquidity of getting in and out of large position sizes is very hard. They're extremely wide, what we call bid-ask spreads, which is the spread between the best bid and the lowest ask. It's just you just don't do it. It's literally almost like trying to run an F1 race in a neighborhood. It's just not going to happen. So stay away from penny stocks. Don't even discuss it. Don't even look at them. It's a waste of time. You should be looking at blue cap stocks. You should be looking at stocks that are in the $1 billion and above. You should be looking at stocks that are blue chips, the Apples, the Microsofts, the Amazons, stocks that have lots of liquidity, and stocks that you're not worried that even if you do mess around a YOLO or if you make a bad trade, that you're not going to blow your account up. Now, number 6, let your winners run and cut your losses. Now keep in mind, I'm talking about from a day trading perspective, not from a swing trading and not from an investing, which is multiple months and over years. Letting your winners run and cutting your losses is very important. And what I mean by that is that when you are trading, you see that a stock is at a certain support level and you want to enter into that stock. Then that stock sometimes will go down and it may hit another support, and then it may bounce up to your level, and then it may bounce down again. Or it may just continue to run down. Or maybe you're a few minutes early or later, what have you. You want to make sure that when a stock goes against you and it is beyond what you're willing to lose on that particular trade, to just get out of the trade, right? So if you see a stock that's at a certain level and it's very oversold at a certain support level, and you enter in, and then you see that stock may then turn around and try to break through that support that you just bought on, just get out of the stock. There's no point in trying to hold it and hope that it goes up and makes money. Just get out and wait for it to show that it's going to actually support that level and then go back up again. And then when it comes to your winners, a lot of the times it's not about being right in that particular moment. Meaning, maybe you're a few minutes off, a few seconds off, what have you. But when you actually go and you make a trade and you see that the trade goes in your favor, don't get afraid and then immediately sell. I've made that mistake, and I even still make that mistake a lot of the times, even today, depending on the position size, right, that I'm trading with. I generally find that if I'm trading with a larger position size, I'm less tolerable with how much I'm willing to let the stock trade with, how much I'm willing to range, I'm willing to let it go. But the smaller the position size, the more I'm patient with it and I allow my positions to grow. I'll even give you guys a quick story here. I have a family member who actually I told to buy Bank of America just a few days ago. And she's relatively new to the stock world and to the investing world, but she's actually very successful and is already very good at it. Well, she purchased Boeing a few days ago and purchased it with a much smaller amount size than I actually have been day trading with it. And I made a pretty good amount of day trading funds. I've been making some money into it, but she purchased it, much smaller position size, bought it for the long term, walked away, And a couple of days later, she's like, oh, wow, I'm up this amount of money. And actually, she'd made more money in a couple of days than I actually had in day trading with a larger position size. So that just goes to show you that when it comes to day trading or really investing in general, it's very important to let your winners run. Okay. Now, I've already touched on this one, but this is super, super, super important. This is probably just as important as number 4. And again, all of these are very important, but some of them are just a smidge more important. Like, you know, if you can only take a couple away, the emotions would be very important. The support and resistance is very important. And then the 7th one, I think, is the top important. Maybe I should rename this to the top 3. The number 7, buying high and selling higher will get you killed. Okay, buy off support and sell off resistance. I'm going to say that to you guys again. If you've gotten this far in the video, you deserve to be rewarded. So I'm going to tell this to you again. Buying high and selling high will get you killed. Buy off support and sell off resistance. Day traders, most day traders understand, and if you don't, I'm going to give you the game now. Okay. 80%, 90% of the volume in the stock market is algorithms. It is the very complicated AI, artificial intelligence, real-time learning, super complex algorithms that only 4 or 5 really large institutions and a lot of other smaller, high-frequency trade companies, larger high-frequency trade companies who have very, very high-speed data backbones to the stock exchanges, like literally right connected to the stock exchanges that they use, that they buy and sell. A lot of them are just scalping, and a lot of them are the market makers for the stock. And their job is to take your money. They are literally programmed to do that. And we're not talking about red, green, yellow, up, down, Tuesdays. We're talking about very complex algorithms that are constantly drawing charts to make you think a stock's going to break out, and then it dumps it, and then it's constantly making you think it's going to dump it, and then it rips it, and then when you think that it's going to rip it, it'll dump it, and then it'll rip it again, and it always seems to be one step ahead of you. And this is why a lot of people lose money in the stock market day trading. It's because they're looking at stocks on the daily and they're saying, oh my God, I see a triangle pattern and I think it's going to break out from this. Let me go ahead and buy it. And then seconds later, it just dumps. And you're like, well, what the hell? The start chart pattern told me it was going to break out, and then it didn't. Well, the market makers drew that pattern. Okay. Or when you see a stock is going to dump and it keeps hitting the support level, then you go down like, oh shoot, I've been watching it. It's been hitting the support level 3 times. You know what? I think it's weak. Let me go ahead and short this stock. And then it rips on you. And you're like, well, damn it, it's been hitting on the support all day longer. Then at the end of the day, it rips. And you're like, well, how the hell did it do that? It just doesn't seem natural. And it's because, the algorithms and the big institutional companies, they are constantly trying to go against what the general consensus is. That's why the stock market, when everyone is so bullish, all of a sudden it just dumps on us throughout the day. Or when everyone is so bearish, and like last month with the whole viral deal, they just rip it on us when we think that the next Armageddon is coming. It's all algorithms. It's all government. It's government with the federal surplus. But from an investing standpoint, that's what it does. And so to increase your odds, you have to buy low and sell high. Always buy off of support levels. And so if you're serious about this day trading process, you're going to have to make sure that when you're looking at a stock, if it's an Apple, if it's a Tesla, Microsoft, Amazon, Exxon, whatever it is that you want to trade, Johnson & Johnson, it doesn't matter, IBM, just pick something that you're comfortable with. Make sure that you identify the support levels on those stocks, and that's where you buy. And then when it hits resistance, that's where you sell. So guys, listen, I can't thank you enough. If you have endured 24 minutes of my very boring, monotone voice, you deserve more than to be a successful day trader. I can't thank you enough, guys, for getting this far into the video. I hope that you take the steps that I've given you, and I hope that you guys take that to heart, and that you practice, and that you're learning, and that you take your time, and that you kind of dip your toe into the markets and you play around, and that you guys are successful. I would love to hear about your comments below. to whether or not you guys have instituted some of these already. If you think that these are your top 7 things that you guys are doing to day trade, what has helped you guys be a great day traders, or what is it that you're doing now that's motivating you guys to get into the market? So thank you so much. If you haven't already, also please make sure that you like the video, make sure that you subscribe, and make sure that you guys leave a comment. You know, the algorithms, they don't know a good video from a bad video unless people are watching, unless people are liking it and subscribing and commenting. So hopefully you guys, if you found this very valuable, make sure you guys are doing that, and I will make sure to try to continue to provide you guys with the great content, and we will go from there. So thanks for tuning in, and I'll talk to you later. Take care.